Okay, so this is going to be a series of videos, probably like two or three, and um, these are probably going to be very important things that I want to tell you, especially new traders that are coming into the market. Um, you have a lot to learn, and we're going to start now. So we're going to focus more on basically how. So the one thing that I wish people taught me was when I first started was the how the market actually moves, where do I put my take profit, my stop loss, and things to that sort. That should be the foundation of your journey of trading to make you more accurate, per se, for the sake of trading. Because honestly, you're I don't look at the most important thing that you're doing is managing the money that you have in your account. And there's things and little critiques that you need to do to manage your money correctly as a trader. And the first thing that we're trying to overcome, there's two things: overcoming the fear of putting trades in, and overcoming how you feel, emotionally. And we'll go over. I'm going to leave the emotional video um, to the side. So we're going to just get with the practical. The practical is price action. Price action always and forever will be this. Price pushes up, and you know what I'm gonna do is this. Let's do it like this. So price does a push for a high. And then we have the exhaustion period. Then we have a higher high. We have a new exhaustion period, and then we have a higher high. Right? Then let's just start from right there. We're gonna start with that much data. In between price doing new highs, exhaustion highs, we have what we would call support and resistance. Correct. There's different there's swing, they could be called swing highs, swing lows, they can be called order blocks, whatever you're trying to, whatever is comfortable with, you know vocabulary wise, is basically what it is. And it's always these sharp moves, and we're going to illustrate that in this video. But your job as a trader is this. So now there's an exhaustion period coming, and price pushes back down to the last retest area, right? So your job is to, let's just say this is the H4, and you'll understand all that as time go on. When the price gets right here, you have two choices. There's always going to be two choices. Whether it's just going to break this floor, retest, and come back to test this, or is it going to make a new high? And based off of everything that you need to know, let's just say it makes a new high. And if as you advance on in trading, you want to get, TP1 are probably the last pullback. TP2 will be the anticipation of the higher high. You want to put your stops below the support, because if it was an actual higher high or actually going and continuing, it shouldn't be a problem where you put your stop loss. Which brings me to the first point in trading. Rule number one is for me. Your stop loss should never be as much as your take profit. I'll repeat that again. Your stop loss should never be more than your take profit. You want to see an example? Here's an example. If I see this and you giving yourself so much breathing room just to go this much, you shouldn't be in a trade in the first place. Remember, of course you're a trader, but you're account management. And think about this, how this stop loss is. And then it's not even correct with market structure in the first place. And I see a lot of this in people. This is not practicing good account management. This is not good account management. Why would you want to give so much breathing room to your stop loss? If anything, it needs to be tight. and take profit needs to be longer. Why? Because if you got a good support and you got your confirmations for it to make the higher high, or confirmations for a break and retest, which those need to be mechanical, then there should be no reason for it to even come break back down here and start doing this, even though, yeah, there's liquidity grabs and stuff, and you're going to figure out as time go on where to put your stop loss. It has to match price action. This is how elementary it has to be. Okay. So like I said, rule number one, this is unacceptable. You're not doing good management. I say go for 2-to-1s and 3-to-1s. This is why it's key to master the higher time frames so you can see the direction where the market is going. Because if this is the H4 or this is the daily and you're patient enough to wait for this higher high to happen where it hits your TP, then you should be good. There should be no problems. So this is the format that we're looking for. And then if you reverse it and make it a downtrend, it should be the same thing. This is what you want your trades to look like. And always get to a point where you're risking 1% to gain like 2 or 3. That way, let's just say it does this. Let's say price does this and it gets right here. And we close half and put stops at break even. And the market does something like this. Let's say it just drops down, right? So let me illustrate. So it comes and stops you out right now. If it stops you out, you already closed half the position. And then I'd rather put my stop loss not at just break even, put it a little bit in profit so you can get some of your profits from that trade. Because you have commissions and stuff. So you want to get commissions out of the way, get you a little teensy bit, feed yourself, give yourself some profit. I wouldn't put it at break even, put it like 3 or 4 pips in. So now you made money off this trade. So guess what? We can wait again when we get back to the support and we see our incentives, our bullish incentives, and it starts going this way, we can re-enter, right? Let's say you re-entered and it actually went and made the higher high. So now you got more profit. Again, like I said, you want to buy as close to the support or the resistance as possible. So now you got the big W, or it hits your TP. And that is how you want your trades to be. Close to so rule number one, never make your stop loss your stop loss bigger than your take profit. That's not good account management. Make sure you buy as close to the support and resistance as possible and have it where you're looking for these your patterns. And we'll have a video. I'll have a video on how to look for the purpose setup and everything. But this is what we're dealing with, just more pure market structure, how the market moves. That's how you want to do it. Now, the second thing and the final thing for this video that I want to talk about is this. Okay, so the market looks like this, but it's not going to look as pretty and elementary as this. So let's take this W. See this W move? We're going to pretend like we're going to a lower time frame. So let's try to duplicate that. So here's that same support that's over here. It's right here, but it's on a lower time frame. And this is something that we do as traders. So say this impulsive move happened, right? So it'll be something like this. So it broke out and stayed right here, and you're looking to get in on whatever. So market pushes up, makes some little baby higher highs, then, pushes back down. It comes up a little again, does this, and come right here, and then start making this W. That's how it really looks, right? Let's just say that's how the market waves look. This move is this move on a lower time frame. Here's the problem right here. So you see the W, which W's are very good to trade off your retest area, especially when it breaks the neckline. When it breaks the neckline and retests and goes up, those are the trades you want to take off of these these support and resistance, but we're going to get more advanced in that as time go on. What you don't want to do as a trader is, like I said, you want to buy as close to the stop, to the support and resistance as possible. So if price already made this move and we're already up here, right? This is the problem that can happen. So I'm going to erase this so I can show you what happens with the data. And this is going to make your trading better. So, okay, the impulsive move, making the floor. Then we got an engulfing candle. Then it retests this. And then we got this move right here, right? So this is all the data that we have. And here you are, oh, the market is going to push up from this point. So you get in a trade, right? You enter right here. But look where your stop loss got to be. Remember, I said we got to trade as close to the support and resistance as possible because this is your new floor. But see, you're trading, and okay, first of all, let me put the ceiling, because we're going to be able to eventually identify the floor and the ceiling of trades. So here is the ceiling, but you're buying up here, the floor down here. You get in this trade like, oh yeah, it's going to make it. And this happens. Drop. This is where we fail as traders, when you don't buy off the floor or sell off the ceiling. This move happens and you're stopped out because you traded in the middle of the floor and the ceiling. This is why I advocate trade as close to that support and resistance as possible, because this is what happens if you don't. So now you're sitting here and dang, you messed up. And then you come back and you see this. Then this move happens. You're like, dang. But if you were patient enough, or if you was paying attention to your pair, you could have just bought off here and just been patient and waited for this move to happen. Now this right here is what this is. That's how the market's really gonna look. It ain't gonna look like this. But if you can, as you get advanced, they'll start looking like this because you won't be worried about all these retracements on lower time frames. So obviously, when all of this was happening, it made the bullish incentives that you were looking for. Then you get in, put it below here. And as you can see, that move, sometimes it wick down there, but it came back up, retested some area and shot up, hit your take profit. You're out the trade. No matter what time frame, H1, H4, daily, 15-minute, all time frames have their own. So every time frame has its own support and resistance, but based off of how you're trading it, and then you'll get into it as you get some experience. That's how we want to trade, right? We want to trade close to that floor as possible. I'm sorry. No, yeah, like that. Stops below that low, because it can also come down. Let's say it came down and wick below that low, which it probably can, but you didn't get stopped out because you put your stop loss below that low. Then wick straight to TP. And that's how you want to trade. You don't want to take any trade setup unless it's close to this. You want your take profit, stop loss to look just like that when you're trading. So as I conclude this video, let's go here to the Canadian versus Japanese yen. I look at support and resistance. You can go on to the charts and you can see that same sharp move. Look, sharp move, right? Sharp move. CAD JPY already broke out of a support. The support was in this area, right? So price had a lot of selling pressure that was pressuring it to go down, right? And it broke. Bearish engulfing, broke, right? So what we would have done is if we knew that there was selling pressure, so high, it failed to make higher highs, so high, then it retraced it, failed, higher high, retraced it. Then when, after seeing, look, because it's going to get really elementary. After seeing these touches on the trend selling pressure, and they're getting lower and lower and lower, market is trying to push down, and here's the floor. Now see, on a lower time frame, after seeing that, after I saw the lower low, you're anticipating for more lower lows. So what you do is this. Let's go back to the daily, because you already see it on the H4. I just want to show you an example, because this trade was taken by the team. So once the lower low was formed, and honestly, one of the things I use is this. Once I saw 3 fractals on the H4, which made that fractal on the daily, because I'm gonna go over the fractals, this is where you get in. Stops below, above, anticipation of the lower low immediately. I put this in, and you put the stops above the previous lower low, because market could have just wicked above it just to take out people to drop down, which you'll figure that out sooner or later. So if you look, low, low, it's like lower low, lower low, lower low, lower low. Then we thinking, okay, it's gonna drop, it's gonna break. Kind of like how I had it up here, but just backwards. You turn this backwards, and a nice breakout of structure on the lower time frame, like this. Take profit was smashed, and the team caught that whole move. Now, go back to the daily, put the fractals on. There's 3 phases of the market, right? The first phase is the push phase. The second phase is the exhaustion. And then the third phase is the continuation. At this point, eventually we'll have a pullback, maybe right here in this area. Let's look at the, see, sharp move, sharp move. Sharp move will probably going to happen when the market opens up. Or maybe it'll break it. Who knows? But just for the sake of elementary, we might have something that comes back and retests this area. Now, if it comes back and retests, in the retest, you look for some bearish sentiments, and it doesn't make it, then the market will continue and make a lower low from this point, which will come back and take out this, structural lows. The market loves to take out the structural lows because we have swing traders that probably put buys in right here, and they have their stop losses right here. So the market's going to come down and wick and probably hit these stop losses. And JPY is already strong as it is because of the Japanese index. It's going to push back up. But so push phase 1, exhaustion period. And honestly, and as time goes on, you use your other tools. If you come from here and put it where this base is at, if it does pull right here, either it's going to get to this 50 golden zone and reject, or maybe it'll come to this retest area and reject. And remember, let's take this off before we conclude this video. Remember, the selling pressure was still on. So it could possibly get right here. Hold on. So before the selling pressure, it might get right there and continue down because there's still selling pressure. So if we take it from that high, oh, wrong thing. So we do take it to this high and put it at that base. Right there is the 50 golden zone. If you know anything about fibs, this is the 50 golden zone. Let's make that gold so you can see. And when it gets to the golden zone, it usually rejects, and then we have a lower low. Now, this is on the daily, so it's going to be a big, deep drop if this happens. But that is an example of, I gave you the example up here where I took it down. So I gave you the example of the swing high exhaustion, swing high exhaustion, but here's the lower low and the selling pressure. So that is what we're looking for. We're really not even looking to take this pullback. If you want to, you can scalp it, take it, because possibly after seeing this bullish engulfing candle, where it engulfed this whole thing, when you see a bullish engulfing candle, it usually continues. And we'll go over that as time goes on. So that is the basics of a trader being successful. Your money management, you're managing your account, you're getting into trades that make sense. It has to make sense. If it doesn't make sense, don't get into it. And you're making sure that your stop loss is not 60 pips and your take profit is 40. No, you want your stop loss to be as tight, airtight as possible, meaning buy off of the support. Now you see how right here, before we conclude, let's say it broke and it retests, and right here, it tried to come out, and I would wait. It made a hammer. And it probably wicked a lot of people out. So right here is a good example to go long after the hammer closed. And you go for the highs. And you put it below that wick of that hammer. And look what happened. And it would have been up more. But these were the structural highs at that point. Right there. So you would have took it right there. Would you had your stop loss below that. Now you see how the stop loss has no breathing room? And you took it right to these highs, or maybe it's probably those highs. By those highs. And they even went there. This would have been a perfect trade. And even, this looks like divergence was, and we'll go over that as time go on. I don't want to give too much if you're new, but structural highs were taken out because it broke this area, which, as you can see on the chart, this is a legit area. See all the sharp moves, and sharp moves. When I say sharp moves, it's both signs of acting as both support and resistance. This is support, that's resistance, 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 support. And lie to take out the structural highs. And a lot of people probably put sales right here because thinking it was going to drop back down, but look what the market did. Came out here, took out all these people that swing trade just to drop back down. So as time go on, I know this looks like jibber jabber, or if you already know what it is, you already know what it is. Time go on, the more you stare at these charts, the more you understand what you're looking for. Things will get better and you'll be profitable in no time, but you gotta get those points down. You can't just get in the trade just to be getting in a trade. You can't have your stop loss and take profit anywhere. It has to be below the support and then come in to take out either the swing high or whatever you're looking at just based off of market structure alone. Right? All right. Until next time, I will see you on the next video. Peace.